Monday, April 19th, 2021, Maneco 64, home of alternative economics and contrarian views. This morning, we're going to look at how a tsunami of cash held by consumers, held by the public through the crisis of the last 13, 14 months could trigger even more rising prices. It won't be inflation. It will be the consequence of inflation, of course. A lot of people would call it inflation, but we know that the definition of inflation is the creation of money and credit out of thin air. So I saw this morning a headline in the FT, and I don't think they're concerned about the inflation. The globalists, the central bankers, the people that run this system, they think they can turn on and off the inflation thermostat. But it says global savers 5.4 trillion stockpile offers hope for post-COVID spending. You see, the Keynesians, they think that only spending grows the economy. They don't look at it in the perspective of the Austrian School of Economics, where to spend, of course, you need to produce, to consume. Every producer is a consumer. For the Keynesians, all they want is spending and borrowing. And I'm going to look at the inflation calculator from the Bank of England back in the 19th century. And you'll see that the fallacy that we need inflation to grow is just a fallacy. So let's quickly look at this. It is from the Bank of England. It's their inflation calculator. Of course, is the calculation of a basket of prices. So if we go back to 1821, these numbers go back like 800 years, the inflation data for the Bank of England. But in 1821, the Bank Restriction Act of 1797 was discontinued. The Bank of England started paying its notes, redeeming its notes in gold again. They had suspended it during the Napoleonic Wars. So if you look here, 10 pounds in 1821, by 1914, just under 100 years, you only needed 9 pounds 51 to get the same amount that you needed back in 1821. So as you can see here, according to the Bank of England, inflation average minus 0.1. And the debt to GDP, of course, dropped massively, the national debt to GDP, not only on a percentage terms to GDP, but also the national debt dropped on a real basis. I think it was around 800 million at the end of the war, and then it was around 600 million before the start of World War I. Of course, World War I, that crisis engineered, in my opinion, also ruined Britain, put Britain on the road to ruin. It would take a few more decades for the pound not to be the reserve currency of the world. But you can see that the British Empire in the 19th century was built on a solid foundation of sound money, and there was minus 0.1% inflation a year. So all those people out there saying that we need inflation, it's good for the economy, it gives it a coup de whiskey. That's a comment I think one of the central bankers said, that we need a bit of inflation. But what a sound economy needs really is sound money, honest weights and measures. And yes, there is talk that the Chinese are buying a lot of gold and that they could come up with a digital yuan backed by gold, and that's very possible. I think the Chinese know their history very well. They're not silly, and they've looked back and seen that a strong nation, a strong country, and I don't even think the Chinese are looking to have an empire. I think the Chinese want to do business with the world. Yes, it will evolve into an empire. It's already doing so, but they know that you need a sound foundation of of gold to do that. So I wouldn't put it past them to institute a Chinese yuan digital backed by gold. Let's quickly go through what this article says. Global Savers 5.4 trillion stockpile offers hope. Households amass extra cash equivalent to 6% of world output since pandemic began. So there you go. The other problem as well, a lot of this cash has been accumulated not through production, not through real savings. It's been accumulated by a lot of people staying at home, getting paid not to work, getting stimulus checks. And you can see here, households have saved a lot more since the start of the pandemic. They call it excess savings. That's another comical term that the Keynesians use. How can you have excess savings? The more savings you have, the more you can invest. But I'm not sure the general public, especially people who haven't really earned their savings, will invest it. They will probably spend it. Unfortunately, that's the way the world works. Usually people at the bottom of the economic ladder, when they get easy cash like this, they will spend it. They don't know how to invest it. And so it says US, not surprising, UK, Canada, so the top 3 Anglo-American countries there, and Russia and Japan at the bottom. So above average really for Western Europe. And that's why I think, yes, the debasement of the currency is going to continue. That's why physical gold and silver are going to protect you versus currency debasement or the consequence of inflation. We're already seeing shortages of silver, especially. A lot of talk in the markets about synthetic silver, unallocated silver, Peter Schiff. How do I feel about Peter Schiff and the product he's selling to his clients? Well, it's all there, transparent. He says it's unallocated, and you need to do your homework before you put your money into an investment. So I personally wouldn't encourage, if I had a business like that, people to buy unallocated silver, because it's as good as buying air, really. So with that, let's quickly look at where the markets are this morning. It's 8:39 a.m. London. We've got spot gold 1782. It's up $6. So we're continuing to see gold go higher. The technical picture, as I said on Saturday, I made another video about it. It's looking very good. It looks like we're confirming the double bottom that we saw in March. We've broken through the midpoint of the double bottom, which was around 1755 or 57. And yes, silver, unfortunately, is being kept lower this morning, which is kind of worrying. But in the short term, this means that usually the bullion banks can't keep gold down, so they're trying to keep silver down. It's easier for them to keep silver down, and eventually when New York comes in, they'll be able to take gold down. We'll have to see, because silver is down on the day here. While gold is up 1/3%, silver is down 4 cents at 25.91. The high has been 26.12 and the low 25.68. I think they're desperate. I think tomorrow Wall Street silver has this campaign for people to go and buy an ounce of silver. So maybe you should look into that. Wall Street Silver subreddit or Wall Street Silver official channel on YouTube. Am I going to buy some more silver? I'm thinking about it. I've been buying silver the last couple of months. I try to buy a little bit here and there. I don't try to go all in. I try to basically dollar cost average. What about the stock market? Well, the Dow is down 95 points. The future at 34,100. NASDAQ 100 futures up 8 points. S&P 500 futures down 7 points. So fairly quiet, the markets. Sterling is up just under 0.2% at 138.60. The euro is unchanged, 119.86. It looks like that 120 level is a good resistance now for the euro versus the dollar. The dollar is down 1/3% versus the yen at 108.38. The dollar yuan is down 0.2 at 651.40. So yeah, that 650 level is very important. We've been below that level. I think we're going to retest it. So to some of my viewers in India, I'll look at the rupee today a little bit. I was just reading a headline that the rupee is dropped about 3% versus the dollar in April, that the rupee had done well since the beginning of the year as an emerging market currency. So yeah, that could be another signal that we might see a lot of demand for gold and silver from that country if their currency is going to depreciate more. Rupee doesn't look that bad because we've been a lot higher. The dollar has been a lot higher than it is right now. Back in March last year, the dollar rose almost to 78. So this is something to keep an eye on for my viewers in India about their currency. Of course, when that price there goes up, that means the rupee is going down. That means the dollar is going up. So to finish off, just quickly look at the 10-year yield, the bond market. It looks like, yes, magically yields are falling. The 10-year yield right now is at 156. It's down about just over 1.5 basis points. So from all the worries that people had a couple of weeks ago or 3 weeks ago about all the supply that's coming out in April, it seems to not be materializing for now, but we're going to keep a close eye on the US Treasury bond market. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.